Listen carefully, because markets don't scream before they crash, they whisper. This Monday, gold and silver are not just falling, they are sending a warning. What you're seeing on the screen is not normal profit-taking, not a healthy pullback. This is the kind of price action that quietly wipes out fortunes while people are still convincing themselves to stay calm. History shows one brutal truth. When emotions say hope, markets deliver pain. Hope has never saved a portfolio. Timing and awareness do. This move in gold and silver is being misunderstood by most participants, and that misunderstanding is where real damage begins. What we are witnessing is not a routine pullback driven by short-term profit booking or technical noise. It is the early stage of a macro repricing, where global money flows are responding to deeper economic forces. When inflation expectations, interest rates, and growth outlooks begin to realign, assets that once felt safe can suddenly become vulnerable. For months, precious metals were supported by a powerful narrative. Inflation would stay high, central banks would be forced to ease, and currencies would lose purchasing power. That narrative is now cracking. Economic data is refusing to collapse, labor markets remain tight, and policymakers are signaling restraint instead of rescue. Markets move ahead of headlines, and gold and silver are adjusting to a world that may stay tighter for longer. Another critical factor is liquidity. In easy money environments, gold and silver thrive because excess capital looks for protection and speculation. But when liquidity starts to contract, investors are forced to prioritize efficiency and yield. Capital doesn't disappear, it relocates. And right now, it is moving away from assets that do not generate income and toward those that benefit from higher real returns. This is why calling this move a dip is dangerous. Dips exist inside trends. Repricing happens when trends are questioned. Once markets begin to doubt the assumptions that lifted prices in the first place, support levels lose meaning. What once looked like strong demand turns out to be fragile positioning, ready to unwind faster than most expect. History is unforgiving on this point. Major losses are rarely caused by sudden crashes. They are caused by slow realization that conditions have changed. Investors who fail to recognize macro shifts early often hold through decline after decline, waiting for a recovery that arrives much later or at far lower prices. Understanding that this is a structural adjustment, not a temporary pause, is the difference between protecting capital and watching it erode quietly. To understand the pressure on gold and silver right now, you must first understand the power of currencies. Precious metals are priced globally in dollars, and when the dollar strengthens, it mechanically tightens financial conditions across the world. A stronger currency makes gold more expensive for non-dollar buyers, reducing demand at the margin and accelerating downside momentum. This relationship is not emotional or speculative. It is mathematical and relentless. What makes this phase especially dangerous is that the dollar's strength is not coming from panic, but from relative confidence. Compared to other economies, the United States continues to offer higher real yields, deeper capital markets, and perceived stability. When global investors seek safety, they don't always run to gold first. They often run to cash, and more specifically, to the strongest currency available. That shift alone can overpower traditional safe haven narratives. Real interest rates add another layer of pressure. When yields rise faster than inflation expectations, holding gold becomes increasingly unattractive. Investors are effectively paying an opportunity cost to hold a non-yielding asset, while risk-free returns improve elsewhere. Silver, which relies partially on industrial demand, faces a double hit as tighter financial conditions raise concerns about global growth and manufacturing activity. This is how currency strength silently drains life from precious metals rallies. Even strong geopolitical headlines struggle to push prices higher when the currency environment is hostile. You may see brief spikes driven by emotion, but without currency support, those moves fail quickly. Markets are brutally efficient at exposing false confidence. The biggest mistake investors make during such phases is ignoring currency signals altogether. They watch metal prices in isolation, assuming fundamentals will eventually reassert themselves. But in global markets, currencies are the transmission mechanism for all stress and opportunity. When the currency tide is moving against gold and silver, fighting it is not conviction. It is denial, and denial is one of the most expensive positions an investor can hold. Market movements always reveal who is acting first, and right now the behavior of price and volume suggests that experienced capital is quietly stepping back. Large institutions do not announce their exits. They distribute risk gradually, using periods of stability to reduce exposure. When gold and silver fail to hold key levels despite supportive narratives, it signals that informed participants are no longer defending those prices. Smart money operates on probability, not belief. These players study positioning, sentiment, and macro alignment long before retail investors react. When trades become crowded and upside potential shrinks, professionals begin locking in gains or hedging downside risk. What looks like patience to the public is often strategic withdrawal behind the scenes. One of the clearest signs of institutional repositioning is the character of rallies. Instead of strong, sustained advances, we see sharp but brief rebounds that quickly lose momentum. These moves trap late buyers who mistake relief rallies for trend reversals. Meanwhile, larger players use those moments of optimism to continue lightening their exposure without causing panic. Another warning signal comes from volatility behavior. When downside volatility expands and upside volatility compresses, it indicates imbalance. Markets are telling you that fear is being expressed more aggressively than confidence. This asymmetry rarely appears at the beginning of bull markets. It shows up when distribution is underway. Retail investors often realize this shift only after significant losses have already occurred. By the time headlines turn negative and sentiment collapses, smart money has already repositioned. Understanding this sequence is critical. Markets reward those who recognize distribution early and punish those who wait for confirmation that arrives only after the damage is done. One of the most underestimated risks in investing is emotional attachment to a narrative. Gold and silver are not just assets. For many people, they represent safety, history, and protection against uncertainty. Over time, this emotional connection can cloud judgment, making it difficult to objectively assess when conditions have changed. Markets, however, do not care about beliefs or intentions. They respond only to flows, incentives, and risk. When prices begin to fall, emotionally attached investors often shift from analysis to justification. Every decline is explained away as manipulation, temporary noise, or an opportunity to add more. This mindset can be comforting, but it is also dangerous. The longer emotions dominate decision-making, the harder it becomes to act rationally, even when evidence continues to stack against the position. As a financial advisor, I have seen this pattern repeat across cycles. Investors hold losing positions not because they lack intelligence, but because exiting feels like admitting failure. Yet markets do not reward pride. Capital tied up in a declining asset is capital that cannot be deployed elsewhere, and the opportunity cost quietly compounds while attention remains fixed on the past. Emotional attachment also distorts risk perception. Losses are minimized in the mind, while potential recoveries are exaggerated. This imbalance leads investors to tolerate drawdowns they would never accept in other circumstances. Over time, what began as a strategic position turns into a defensive stance, driven more by fear of regret than by forward-looking analysis. Discipline is what separates survival from damage in such moments. Stepping aside is not surrender, it is strategic clarity. The ability to detach emotionally and respond to changing conditions is a skill, not a weakness. Those who protect their capital during uncertain phases preserve not only their money, but also their ability to act decisively when genuine opportunities return. In every market cycle, there is a moment when the priority must shift from chasing returns to protecting what has already been earned. This is that moment. When uncertainty rises and trends weaken, the objective is no longer to be right about the future, but to remain financially intact in the present. Survival is not a passive stance. It is an active decision to respect risk before it becomes destructive. Many investors misunderstand preservation as fear or weakness, but in reality, it is the foundation of long-term success. Capital is the oxygen of opportunity. Without it, even the best future setups are meaningless. Markets are generous over time, but they are ruthless in the short term, and they do not hesitate to eliminate participants who ignore risk during unstable phases. There is also a psychological advantage to stepping aside when conditions deteriorate. When you are not emotionally or financially trapped in a falling market, your perspective improves. You begin to see opportunities more clearly, rather than viewing everything through the lens of recovery. Distance restores objectivity, and objectivity is one of the most valuable assets an investor can possess. History repeatedly shows that the biggest gains come after periods of discipline, not stubbornness. Those who preserve capital during drawdowns are the ones who can act decisively when momentum truly shifts. They are not forced to recover losses. They are free to allocate from a position of strength. That flexibility is what separates professionals from casualties. Markets will always present another chance. Another rally, another trend, another story will emerge. But capital lost to denial rarely returns easily. Choosing survival over speculation is not about giving up on opportunity. It is about ensuring you are still standing when the real opportunity arrives. The market has now done its part by sending the signal. What happens next depends on whether you respect it or resist it. Wealth is not destroyed by bad luck. It is destroyed by hesitation when action is required. If prices continue to fall, they will not pause to ask how strongly you believed in the story. Step back, protect your capital, and let clarity return before confidence does. Remember this: you can always re-enter the market, but you can never recover money lost to denial. The smartest move right now is not to predict the bottom. It is to make sure you are still financially strong enough to benefit when the next real opportunity finally arrives.